Well, welcome everyone. We're sorry everybody that's listening to this couldn't be in person. It's always fun when we can do these events live. We do want to say thank you very much for taking the time to listen to this webinar. As you can see, it's a joint webinar between Rooted Planning Group and 100 Degrees, which is a financial leadership company. We're really very excited and thrilled about a collaboration that we're going to be talking about more and more as time goes on. But we're going to be talking about today last minute planning tips for small businesses and what you can do in 2020 to make a 2021 successful year. And we're going to be talking about what it means to hire a CFO to a certain extent. So we're very thrilled. Joining me today is Kate Welker, a CFP from our team, and Stephanie Skrykowski. Did I say it right, Stephanie?
Pretty close, Skrzowski.
I have a hard time with those long words, I guess you want to say. Math was my favorite subject. Apologies for mispronouncing it. She is the founder and CEO of 100 Degrees, so we're thrilled to have her here today as well. Digging right in, a couple of last minute tax tips and things that we want you to know about 2021 and 2020 is that you still have time in 2020 to maximize those contributions if you need to or are so inclined. For 401k contributions, if you're under the age of 50, you can put in $19,500. And if you're over the age of 50, there happens to be a benefit, you can actually put in $26,000 plus your employer contribution. So if you're a small company, that means that you can maximize your employer contribution as well as your employee contribution. Also in 2020 and 2021, you'll be able to contribute to a Roth or a traditional IRA. I know if you're under age 50, it's 60, and if you're over age 50, it's 7,000. I think I said 60, I meant 6,000. And one of the things that we talk to people a lot about, if you aren't able to make a deductible IRA contribution, but you earn too much to make a Roth IRA contribution, is what's called a backdoor Roth IRA contribution. There's still time to do that. In fact, that goes until April 15th of next year that you can do those kinds of contributions, whereas the 401k has to pretty much be done by the end of this year. At least the employee side has to be. Then simple IRAs, you can put in $13,500 or $16,500 if you're over the age of 50, again, plus the employer contribution. And then the final contribution that you can make for retirement is what's called a SEP. Now the formula technically says $25,000 up to $57,000 that you can make, but in reality, the calculation ends up being closer to 20% because we have to take into consideration some self-employment tax. Now, again, that contribution can be made in 2021 for 2020 up to your extension. So whereas the IRA and the Roth has to be made by April 15th, even if you extend, the SEP can be pushed out later into the year. So we use that as a planning tool a lot of times if it looks like you're going to owe enough in taxes to require you to pay in. We'd rather you save it in your own bucket versus paying it into the IRS. The HSA, which is a health savings account that is connected with a high deductible plan, which this is different than what's called an FSA, which is a flexible spending account, because this can be rolled over if it's not used. Now, we're big fans of health savings accounts. We love health savings accounts. There is many people that are never going to meet the deductible and would be able to contribute the maximum. And even if you do meet the deductible and exceed that, oftentimes if you're a really high user, I mean a super high user, it actually makes sense to pay lower amounts in premium, sock away the HSA, and meet the maximum out of pocket, which is often lower than a traditional PPO plan. Again, these are all planning opportunities. But for an HSA, you can do $3,550 for single, $4,550 if you're over the age of 50. Now in 2021, that is going up slightly. It's going to go to $3,600 if you're single and $4,600 if you're over age 50 and single. On the family side, in 2020, you can do $7,100 and then 8,100 if you're over the age 50. And then again, it's going up just a tad bit in 2021 to $7,200 for married and 8,200 if you're married and over the age of 50. So these are dollars that you can put aside towards the high deductible if you ever need it. But if you don't need it, it just rolls over year after year after year. And when you turn 65, you can actually use it for whatever you want. It kind of quasi turns into an IRA. So if you have years to build this account, it's very advantageous for you to have that additional bucket that you can save into. Now there is the flexible spending account, which you can also use, and that you can only carry forward $550, and that limit in 2021 is going up to $2,750. Those you usually have to make the election at the very beginning of the year, and although the accounts are funded by the employer usually at the beginning of the year, that is a use it and lose it. You only get to take the $550 as a carryover. So be aware of that. On the dependent care side, the flexible spending account is staying at $5,000, and that is a use it or lose it. You can prepay anything into 2021 with any 220 or any balance of 2020 if you happen to have anything left over. Nice contribution towards the cost of any dependent care. And remember, dependent care could be for your children, or it could be on the other side. If you have a brother or sister or parent that you're providing daycare for, dependent care for, you can utilize those monies. Now for income in 2020, certainly was an unusual year. And so it's been interesting planning for the adjustments that we need to make in 2020, because many people did receive unemployment in unusual circumstances that they normally would not have received unemployment. And because of that, they may or may not have had enough taxes withheld. Sometimes they forget to have taxes withheld. And one other thing that we always want to mention to people with unemployment, some states don't always send you the actual 1099. So you have to tell your tax preparer, tell us if you got unemployment, because we have to go out online and sometimes get that. That really gets people sometimes when that happens. But you may need to plan for estimated taxes because you received unemployment. In 2021, we probably need to be looking at redetermining or readjusting income and planning for estimated taxes. Now, the IRS has a great website on the withholding calculator. And the reason that we like that particular withholding calculator is because the new form that they created is all but not helpful. It is the worst remodel that could have ever taken place in the IRS forms, in our opinion, because it really is very challenging when you're trying to plan for multiple sources of income and have the right withholding, especially if your income is variable. Make sure that you take any last minute deductions to offset any income. For many people, this was a very good year for them. It ended up really turning around towards the end of the year. And we need to make sure that if you do have unemployment along with your ordinary income that you didn't expect to receive but did, we need to be looking at taking any last minute deductions that you can possibly take. You've got about 2 weeks left in the year to be thinking about that and asking those kinds of questions. If you didn't receive much income this year, if this was one of the lowest income years that you've ever had, we think that you should consider a Roth conversion, because if your income was down significantly, this may be the lowest income tax year that you'll ever actually be in. And by taking a traditional IRA or an old 401k and converting it into the Roth, you're paying the least amount of taxes on it that you probably will ever pay in your lifetime. We have seen a lot of opportunity for that this year, especially if people survived on like the PPP loans, or maybe they borrowed under the EIDL program to keep their business going. Their income profitability is still really low because those aren't income items, right? So again, that might be something that you would want to consider in the next couple of weeks. And you do have to do it within this tax year. You don't have extensions to take care of that in. Be aware of some possible capital gain distributions. Although in March and April, we thought the year for sure was going to end on a down note. Clearly, it's recovered pretty significantly, and there may be some capital gain distribution surprises, as we call them. That's when mutual funds have some profits that they have to push out to individuals because they don't want the mutual fund itself to be taxable. And they can be a bit of a surprise for people when they haven't sold anything to their knowledge at all. They just simply are getting these distributions that tend to get reinvested right back into the mutual fund. But they are a surprise when you go to complete your tax return in the next year. Be looking for capital gain and loss harvesting. So I know earlier this year we did take advantage of some losses that took place. We held on to the cash and then reinvested it at some point in time when we felt that we could rebalance the portfolio. So be looking for opportunities within your portfolio. If you had some losses earlier this year, you may want to take some capital gains so that it offsets it. Or if you had some capital gains, you may want to look for losses to offset those capital gains in 2020. And then finally, pay attention to those dividends. There's a difference between qualified dividends, which get the capital gain tax rate, and ordinary dividends, which are taxed at your ordinary income tax rate. Be aware of the differences between those two. Most mutual fund companies actually do send out some estimates. They're not perfect, but they send out some estimates this month, in the month of December, to give you some idea of where you're coming in with some of those items. Be aware of a couple deductions that you might not normally be eligible for under the CARES Act. You will get a $300 above the line deduction. What I mean by above the line is that if you wrote a check for an aggregate amount of checks for $300, you can actually get that charitable contribution, where normally you have to itemize your tax return and your itemization has to be higher than the standard deduction amounts, right? So this year under the CARES Act, there was this provision that was thrown in there that said anybody who makes a charitable contribution at $300 or up to $300 can actually take that on the, what we used to call the front side of the tax return. Now we refer to it as above the line deduction. Your standard deductions for 2020, just so you're aware, because we really don't start talking or thinking about 2021 all that much until about mid-year, but we want you to be aware of what your standard deductions as you go into this tax season. For 2020, you have a $12,400 individual, $24,800 for married. If you're married filing separately, it goes to half of that, which is $12,400. And then if you're doing head of household, you have a standard deduction of $18,650. In order to take advantage of itemized deductions, you'll have to exceed those standard deductions. And the things that you might be able to get you above those levels would be donor advised accounts. And remember, you're limited to a $10,000 SALT limit and perhaps your mortgage interest. A lot of the other ones are not applicable to most people. Now, on those donor advised accounts, one tip that we would have is if you have a highly appreciated stock, meaning a stock that you've held on to that has a very low basis, meaning you bought it very cheaply compared to where it's at right now, you can donate that stock into the donor advised account. You don't have to recognize the gain. So you don't have to sell anything. You don't have to recognize the gain, but you get to take a deduction for that donation. And many of our clients are donating some of their appreciated stock over this year to try to get over the itemized deduction level. And you don't have to distribute it all within the same year either in order to get the deduction. So for example, if you were somebody who bought Corning stock many years ago when it dipped way down under like $2, right? And it goes up to $38, right? So there's a huge gain of $36 in that situation. You can actually transfer so many shares over into this donor advised account. And that's when you get to take the deduction, even if you don't distribute the actual dollars until 2021 or 2022. We love donor advised funds as a way to get yourself above those itemized deductions if you need to. With that being said, Kate, I will turn this over to you and I will make you a presenter.
If you want to just advance for me, that's fine too, Amy.
Okay, that's fine.
Just through that one slide. So I'm going to take a few minutes to talk about some end of year tax planning moves for a small business owner in particular. It's really good this year. As Amy mentioned, this has been an unusual year. So you should always at this time in December, as we're looking down the end of the year approaching, review your financials and get a tax projection run based on those numbers, and especially with some different things we've seen in the current scenarios. So the first step in this is to make sure that your financials are up to date, because it's difficult to get accurate numbers without good statements. And by Financials, I mean primarily your profit and loss statement and your balance sheets. Once you have these together, reach out to your tax professional, share these numbers with them so they can run a tax projection, which is basically an estimate of what your tax return is going to look like to see what your overall situation's anticipated to be. By that, I mean, are you on track for where you thought you would be this year? Are you going to have an unexpected profit, and AKA a big scary tax bill? Or do you have a loss maybe this year and you want to do some things to take advantage of the fact that either you have a loss or to kind of push out expenses into the next year? So once you've done that, what do you do? Is kind of the next step. Many of these things I'm talking about are a little bit easier to do for someone on a cash accounting basis versus an accrual accounting basis. Accrual can be a little more difficult, but if you are, just speak with your accountant or tax professional and they can still work these strategies. And just so you know what I'm talking about, cash is basically when you have it in your hand, you count it. So if you make income and you get that check and deposit it, you count it as income. The day you make the payment to buy something, you count it as an expense. We're on an accrual basis. When you earn it. So when you go do a job for somebody, you've earned income, you count it whether you got paid or not. So there's just a couple different things on the side that can get messy with the accounting. But again, just be in communication with your tax professionals. So what do you do if you have an unexpected profit? I mentioned that big scary tax bill coming up down the road. So there's still a couple of weeks left in the year and a few things to look at. The first is timing of large purchases. And by a large purchase, I usually mean things dollar-wise over about $2,500. And these are items that typically would be depreciated, which means you take a little bit over a series of years, depending on the type of item it is. But because of tax code, we actually are able to accelerate that and take it all in 1 year. So if you have a large profit and you need a piece of equipment coming up, you could decide to purchase that right now. And then write off the whole amount. So you need to buy, I think big equipment like a skid steer, like $20,000 piece of equipment. You could decide to purchase that in December, write off the whole amount this year and have that as an equipment in next year, but the expense this year. The one thing I do like to add to that is don't spend money just because you're worried about taxes. Only purchase something if you need it and it's already in your plan to purchase it. I've seen people get really panicked and go buy items they don't need, so that's not helping you be successful in your business. So again, being smart about that, but just taking advantage of some tax codes for you. The next item would be to pay any outstanding invoices and clear up your accounts payable. So basically, if there's something out there that can be paid, pay it now. Utilities, supply invoices, materials, honestly, anything like that. If you typically are looking out things you would pay the first couple of weeks of January, consider moving them up and paying them now. Utility bills are a big thing you can do now, just kind of moving those expenses to this year. And the last part would be to delay income. You may not be able to do this. You may actually need that income right now or have payment coming in. But if you are able to push any income out into the next year, this would be the time to do that. So for example, if you had a large project that you were starting in the next few weeks, if you're able to delay that by a few weeks and still keep your customers happy, you could be able to do that and delay that income so you're not taxed on it this year. And then vice versa, if you find out that you have lower than expected profits, what would you do? And honestly, it's pretty much the exact opposite of every step I just went through. So for example, delaying purchases. If you're looking at a large piece of equipment, as long as you don't need it right now, I'd push that purchase out until January and push out the expense into a different tax year. Again, with invoices, anything you can delay paying now, pay in January. Do not accrue late penalties, interest, anything like that on a bill. But again, if usually the biggest thing we think of are like utilities and regular payments. If you typically pay things a little bit ahead, wait and pay them a few weeks later, as long as they're still in by the due date. And then again, accelerating income. So before, when you're pushing off income, in this case, you could bring in any income sooner. So if there's something that you could build out on a few weeks earlier and still be okay with your client base, any jobs that you could move up a little bit just to get that income in, anything you can do possible to put that in this tax year to offset it. So again, they're pretty much reverse. All right, Amy, if you could advance the slide. And then I wanted to touch on briefly the CARES Act, because there were a couple loans out there this year. We had a lot of letters, a lot of acronyms, a lot of time spent in classes and reviewing tax law to figure out exactly what these meant. And honestly, there's still a few pieces that have not been completely decided in how they are going to work yet. So the two that most people have been exposed to or participated in are the Payroll Protection Program, also referred to as the PPP, and the Economic Injury Disaster Loan, or the EIDLs. So the PPP was the one we saw a lot of people apply for. This was to cover payroll, and it could be utilities and some other expenses. The important thing to know here, this is not taxable income. So if you got the loan, it's a loan, and if it's forgiven, it is considered to be a grant. But the important thing is, as of right now, if your loan is forgiven, those expenses are not deductible. And it's also if it's expected to be forgiven. So the SBA has been very slow to process these. So even if you have not gotten forgiveness, but you know you spent it on qualified expenses, your bank has told you it was okay, these expenses still could not be deductible. For an example, if you had a $15,000 PPP loan for payroll, you spent it on payroll and you submitted it, when you file your tax return, those $15,000 of payroll expenses could not be deducted. A lot of people were not aware of this, so I'm worried about people getting caught on this. Here's where I'm going to bring in the big but, though. We're still waiting. There is legislation out there. This was not the intent of Congress when they passed this law, so they have been fighting it, and it is across both, excuse me, both parties. So in the current legislation that they have out there, they are pushing this to be changed because the IRS and the Treasury Department came out with this interpretation. So we are hoping that these new laws get passed the way they are, that these expenses would be able to be deducted, because their view is it's actually putting extra burden on a business owner that was not their intent, was to help out. So it's a little bit of Congress and IRS fighting over that. So we will see what happens, but we have seen that things have been slow to move. So we'll keep you posted there. And then the next one was the Economic Injury Disaster Loan. If you received these, there were two pieces to this. The first part was a grant. The second part was a loan. The grant was up to $10,000, and it was based on the amount of employees you had, $1,000 per employee. And if you were a sole proprietor, that $1,000 could have been for you. And then the rest of it is actually a loan to be paid back. So because it was either grant or loan, it's therefore not taxable income, and all of the expenses are deductible. And again, that grant portion is not taxable. The only little side note I want to add is that if you did get both the PPP program and the EIDL grant, you weren't supposed to double dip. So when you apply for your payroll protection program forgiveness, they will not forgive the amount of the grant you got from the Economic Injury Disaster Loan. So if you ended up getting one of those up to $10,000 grants, that will be taken off of your PPP. So just a few things. It was a strange year, strange programs, letters to learn about, but just a few things to be aware of as you're preparing for that to go into your tax season.
Yeah, and Kate, that's one of the things that, I mean, not knowing, right, with the PPP especially, not knowing, that's one of the surprises that I was referring to earlier, that you may have an unexpected gain this year because you got one of those loans, and normally where you'd be able to deduct things, you're not able to. And so that's where we're worried, especially if something doesn't get, settled before the end of the year. We're operating under what the law is right now, not under what it might be. So, right. So if you have any other questions on that particular, don't hesitate to contact either Kate or I. Kate's email address is kate@rootedpg. Mine is amy@rootedpg. And with that being said, let's see if I can try again to get Stephanie's name correct. Stephanie, you say it. I'm sorry, Stephanie. I'm so sorry.
That's okay. Skrzowski.
Say it again one more time.
Skrzowski.
Skrzowski. Okay, so I might get it next time. I have to be very specific on the vowels and the consonants there.
I know, it's a lot.
Well, thank you very much for taking time. This is a very busy time out of the year for you. I did make you co-host, so I think you should be able to actually change the slides unless you want me to. But I want to welcome you. Thank you so much for taking the time. One of the things that we talk to a lot of our small businesses about is that, they usually get into being a small business owner because they're so passionate about what they do. And we find that, they don't always have the skill to run the business in the same way that they knew how to do the business, right? Because they're two different skill sets. And that's where your company comes in and our company comes in collectively to really work with people and help them figure out how to work on the business instead of just working in the business.
Exactly. So Amy, I don't think that I can control the slides. So I think you're gonna have to do it. Wonderful. Well, so we're going to chat today about 3 different things, really making sure all of your ducks are in a row, like you've got the foundation in place. And if you're working with Amy and her team, you definitely have this in place. But if not, we'll talk about a couple of things there. We're going to talk about really looking back. What is the story that your P&L, that your balance sheet is telling you? And then we're going to talk about looking forward. So really creating a forecast, which it's essentially a budget. We just don't like to use the word budget because nobody likes that word. So it's a forecast, it's a roadmap to help you make smart decisions for your business so you really can achieve your goals. Okay, you can go on. So our business works with purpose-driven businesses and nonprofits. So we're not just out here to make a buck. We really want to make an impact with what we're doing in our business. But if you're not holding on to your money, if everything that's coming in is going right out the door, you're not going to be able to make an impact. Go ahead. So a lot of times when we're thinking about goals and coming up with our revenue goal for next year, a lot of times we're just setting arbitrary goals, right? Like if you run a business, you are probably reading things about entrepreneurship and businesses and, like we want to hit 6 figures, we want to hit 7 figures, I want to hit 8 figures. These goals are so arbitrary. Most of the time, these goals are super, super arbitrary. Go ahead. And so, we really need to sort of connect our personal purpose to what our goals are for our business. And so I was working with a business coach who asked me, what's your revenue goal? And I just, spouted out some number that was $100,000 more than I had made the previous year. And she's like, okay, great. Well, why? Why do you want to make that extra $100,000? And I was kind of stumped. Honestly, I really struggled to answer her because I just didn't really know. But you can go to the next slide. So when you think about what that extra $100,000 could be, for me, it meant being able to save for my children's education and give my 2 girls who are very young, they're 4 and 1 right now, but being able to give them a better start at their adult lives than I had, not graduating college with high 5 figures in debt. So for you, maybe that's, supporting your household expenses or taking a vacation post-COVID, or paying off your mortgage, or donating to causes you care about, or creating space in your life to volunteer, or caring for a sick relative, or even things as simple as monthly massages or date nights. So this, you could go to the next slide. So really, having a sense of ownership and understanding over your numbers, having a little bit of financial knowledge in your back pocket, you really can be the CFO of your own company. And like I said, your business finances are so tied to personal. So you can go, thank you. What if you don't like math, right? You don't like numbers. That's why you're here. You're here to learn from Amy.
Who doesn't like numbers, Stephanie? Everybody likes numbers.
I don't know, because I love numbers. In fact, we get a new Christmas ornament every single year. And the one I got this year was a little gold calculator, like a glass blown gold calculator. Super nerdy, but I love it. I love numbers, but you might not. And that's okay. You can go to the next one. Because it really doesn't have to be hard when you have a system in place, right? When you've got a sort of structure, a framework, a process for managing your numbers every month, and you know exactly what you're looking at. Go to the next. So again, we're going to talk about establishing your foundation, looking back, and then looking forward, forecasting your future. So first, establishing your foundation. What does this mean? So really, this is making sure that you've got your legal ducks in a row, that you have a way to track your numbers on a monthly basis, and then you have a monthly routine. Notice the word monthly, right? This is not something that at the end of the year in December, we're like, oh shoot, probably should have done something with my, with my business financials all year. No, this is a monthly routine that we need to get into. So why does this matter? Because you have to set a strong foundation before you can get any insight out of your numbers, right? Your numbers are not going to tell you the story if they are a hot mess and all over the place and in multiple bank accounts and not organized in any way. So first of all, you got to make sure your business is legit, that you are structured the right way. Amy and her team are the experts in this. I am certainly not, but making sure that you've got the right structure so you're paying taxes the right way. You've got your business bank account and your personal bank account, and they are separate. And making sure that you've got the right tools in place to manage your numbers. And so a lot of times people will ask me, well, what are the right tools to manage my numbers? Like, do I have to have QuickBooks? You don't have to have QuickBooks. You don't have to have anything. You have to have what's going to work for you. And so if that means QuickBooks because it's connected to your bank account, and so you're never like, manually entering data into a spreadsheet, that's great. If you're like, honestly, QuickBooks scares me, I'd rather have it in a spreadsheet, that's okay too. The IRS is not going to tell you need one or the other. You just have to have something that you're going to use consistently. And I've got lots of other recommendations for software and tips and tricks, but we'll just make sure you've got a tracking system for your revenue and your expenses, and then your monthly finance routine. So I really love to sit with my numbers once a month. And of course I love it, right? I'm a CFO, but a lot of the business owners that we work with love to do it as well, setting aside a little bit of time to kind of think in that 30,000 foot level and understand what your numbers are telling you and help you make decisions to grow from there.
And Stephanie, I just want to point out one thing. I guess I want to accentuate one thing that you said is to keep your business and your personal accounts separate. That's probably one of the number one things that we see when we first start working with people is that they've got everything running through the same account. That means even if you have to get a separate credit card that you use only for business, but it has to be in your name, because a lot of times credit card companies won't issue you a business credit card unless you've been around for a period of time. Still do that. Like, get a card, even if your name is on it, and like keep, you only use business expenses on that card. Get a separate checking account. Keep it separate. Do not commingle, right? I just want to accentuate that.
Yes. Yeah. And then that also makes it a lot easier when you are bringing in a bookkeeper and a CFO. We don't have to go untangle things from your like grocery bills and your business bills, because that takes a lot of time. So again, if you're sort of in this small business entrepreneur space and you're reading all the people are telling us we have to outsource this. If it's not your zone of genius, you have to outsource. But what does that really even mean? So I like to think of all these different people as your finance team, right? And a lot of times I feel like there's a lot of confusion, and people think that a bookkeeper and a CPA and a CFO, it's all the same thing, right? We all just deal with numbers. They're actually quite different. So it's really important before you go and outsource to really understand who is who on your team. So your bookkeeper is the person that is in your books on a monthly basis, or on a potentially daily basis, really. They're looking at like every single little transaction, making sure it's coded the right way. They're comparing your QuickBooks, for example, to your bank statements, making sure everything reconciles and ties. Most likely they're, an expert in QuickBooks Online or another accounting software. So they're kind of in the, sort of a ground level line item detail. Your tax accountant, the next person, your tax accountant, is going to be a CPA. They are, your tax, your compliance expert. They're going to make sure that you are doing all the right things with the IRS, with the government, you're paying taxes. And often they are the ones that are filing your taxes as well. Then your CFO, your chief financial officer, this is your like financial strategy person. This is the person that's coming in. They're looking at the numbers that the bookkeeper is coding and preparing, and then helping you really make strategy-based decisions, like growth decisions for your business based on those numbers. So we're the ones that are sort of like telling the story of your numbers, helping you see around the corner, see into the future. And then your financial advisor, they're helping with your investments or fiduciary. They're really looking at a sort of holistic wealth planning strategy, often for not only your business, but your personal as well. So if you ever thought that any of these were the same people, now you kind of understand the distinction a little bit more. All right, so we just talked about establishing your foundation, making sure that you've got a really strong foundation to then sort of jump off and grow from. So the next thing we're talking about is looking back And this is really looking at your financial reports, right? Looking at your P&L. And I call this looking back because, you know, we're looking at history, right? When we're looking at a P&L, it's something that's already happened. So it's really, we do this every single month. We look at what happened last month, what came in, what went out. And then I think the other really important part of looking back is knowing what the numbers mean, right? A lot of times, maybe you get a P&L from your bookkeeper, and you know, it's in a spreadsheet and there's lots of numbers and lines, and then your eyes start glazing over and you're like, okay, I think it looks good, moving on. And you know, you're not really getting anything out of it. So I'm going to show you a couple of things today that can help you make a little bit more meaning out of that P&L. So every single month, there are two reports that I want you to look at, your P&L and your balance sheet. I'm going to show you some examples of these. And then there's a couple metrics that we can calculate very easily. Like, you don't have to do a lot of complicated math, I promise. And there's no like weird accounting terms or anything in here, but a couple of really easy metrics to help tell the story of how your business is doing, so that your eyes are not glazing over when you're looking at that spreadsheet. And then I want you to check your bank balance. So I don't know if you, Amy, tell all of your clients this, but check your business bank balance. I feel like so many times we're like hiding from it because it feels scary and like, oh, I don't know what's in there, I just want to avoid it. But like every single month, at least, if not weekly, I tell all of our clients to check weekly, check your bank balance.
Every Friday, right? That needs to be part of the routine.
Exactly. There you go. Exactly. All right. So, okay. So this is an example of a P&L. So you probably have seen a P&L before for your business, but at the top we have our income, and then we have all of our expenses, and then you have your net income at the bottom, and your net income is just revenue minus expenses. So they all follow the same format. Yours might look a little bit different. It might be called revenue instead of income, but the basic, you know, gist of it is, you know, it looks like this. Now, one thing, oops, you can go back. Sorry. One thing I just want to point out is notice that this is comparative. I go into a lot of clients and I'll say, hey, can you send me your last, you know, a P&L? And they'll send me like just the previous month with no point of comparison. So I have no idea if this $192,000 in income, is this good? Is this bad? I have no idea because there's no point of comparison. So I always recommend having another period there with variance percentages to compare to. Now we're looking in this example at August 2020 compared to July 2020. So it's the month before. You could also look at August 2020 compared to August 2019. Now I would say half of our clients do it one way, half of our clients do it the other. It doesn't matter. You think about your own business and what your own business cycle looks like, what your business model looks like, and that'll kind of tell you what you should be comparing to. Doesn't really matter, just compare it to something. Okay, you can go on. So on this comparative P&L, there's a lot of information like hiding in these numbers. So I'm going to talk about just 3 really easy metrics that you can look at in your business every single month to really give you an idea of how you're doing. So first of all is your revenue diversity. And this is telling you how much revenue is coming from each source. So I think if 2020 has taught us anything, especially in business, that we don't want to put all of our eggs in one basket, right? Because if that basket disappears and all of our eggs are smashed, like we're done. So what I'm seeing this year is our clients that had revenue from a lot of different sources, or at least a few different sources, if one goes away completely, which we 100% saw this year, there's still others to support the business and keep you going while you pivot. So understanding in your own business how much revenue is coming from each source is really important. The second one, and then I just on the right here is just like a little how to calculate. So looking at revenue source number 1 divided by total revenue, revenue source number 1 divided by total revenue, and that'll give you the percentages. Your burn rate tells you your average monthly expenses. So you would not believe, or maybe you would, but when we go into a new client and just kind of having that initial phone call, well, what's your average monthly expenses? People have no idea. They don't know how much money is going out the door every single month. So, this is not something that you need to like broadcast or share with anybody, but you do really need to know how much is going out the door every single month so that you know how much you need to bring in at a very minimum. And so this is very easy to look at or to calculate if you're looking at your P&L for the whole year, January through December, your total expenses just divided by 12. Or maybe you only have financials for January through October, that's 10 months. Take that total, divide it by 10, and that gives you your average, your burn rate, your average monthly expenses. And that's a really important number to know and to compare to yourself, so that you can see, okay, well, last year, my burn rate was about $10,000. This year, oh, my burn rate's like $18,000. What's going on? What's happening? You can see, you know, kind of how things have changed over time. And finally, your profit margin. I think everybody knows this one, but this is just how much revenue is left over after all of your expenses have gone out the door. And so this is an important number to know. And again, to compare against yourself month by month by month. I get the question all the time, what's a good profit margin? And I say the answer that everyone hates, which is it depends, because every industry, every business is different. That's why it's important not to compare yourself against somebody else, because you don't know what the back end of their business looks like. It's important to compare against yourself. So you can see, okay, my profit margin was 40% and somehow now it's like 20%. So what happened in between? So again, these numbers really help you ask yourself questions about your business that are going to help you make better decisions. So the second report that I want you to look at is your balance sheet. Most of the businesses that we work with have a pretty straightforward balance sheet, honestly. So on the top is your assets, and on the bottom is your liabilities and your equity. So your assets are what you own, your liabilities are what you owe. So we always want to make sure we have more assets than liabilities. First of all, that's really important. And then the second thing I want to point out here is that, again, we have a comparison, right? It looks like this, we're comparing Q2 of 2020 compared to Q1 of 2020. If I were to look at just this first column, looking at as of June 30th, 2020, you know, $186,000 in the bank. I have no idea. Is that good? Is that like the worst that they've ever seen? I have no idea without a point of comparison. So the metrics on this one, this is my favorite metric, months of cash on hand. So what this means is it tells you how long you could operate at your current level if not another dollar came into the door of your business. And so this was the metric that everybody, all of our clients were looking at in March of this year. We were trying to figure out, okay, if the world shuts down, which it appears that it is doing as of March 13th, where we're like, okay, how long could we operate without having to make any changes? And so basically we're just taking our bank balance divided by that burn rate that I shared with you a couple minutes ago. And that tells us, okay, we could operate for 3 months. If not another dollar comes in the door, we could pay ourselves, we could pay our team, pay our bills for 3 months. So that, again, gives you this visibility into the future and shows you what your runway looks like, so that you make decisions now rather than making decisions when you're like, ooh, I have $200 left in the bank. I do not know how I'm going to make payroll next week. So again, it helps you have this sort of future vision. And the last metric we'll talk about is the quick ratio. And this really just tells your ability to pay your debts. That's what it's saying. It's just taking your current assets divided by your current liabilities. And like I said, we always want assets to be more than liabilities. So this number should be at least 1 and preferably like much greater than 1. And then the last thing, like I said, is just checking your bank balance on a weekly basis, because what you focus on expands. If you're focusing on your money will expand. I love this saying. It's something I think about all the time, and it really helps me achieve my goals. So the last thing we'll chat about today is forecasting your future. So we just talked about looking backwards, right? Looking at your historical financials. That's what's happened, what has already happened. So in a sense, there's only like, you know, a certain amount of usefulness of looking backwards, right? We can't change anything that has already happened. However, we can use that information to then forecast our future. So this is, like I said, creating a forecast is really just creating a budget, but this is not a cut your lattes kind of budget. Like that's not what we're talking about here. This is really creating a roadmap to achieving your goals. So if you're like, all right, my goal is to hit $1 million in revenue this year. Okay, well, let's just create a roadmap and figure out how to get there. So $1 million means $83,000 a month. Let's lay out our expenses. Let's see what we need to shift. And that's how we're going to get there. Again, I see a lot of times, so many entrepreneurs and small business owners are setting these goals. And if you're like, I'm going to hit $1 million, well, that feels terrifying if right now your revenue is about $300,000 a year. Like, how are you going to make up that difference? But when you start breaking it down and breaking it down into smaller monthly pieces in this roadmap, it feels way, way, way more achievable, right? Maybe if you have to hit $80,000 in revenue per month and you're already at 50, okay, well, that doesn't seem so bad. Now I just have to sort of fill that gap of 30,000 a month to get there. So the forecast is a sort of living, breathing tool that I love to use with our clients as part of their monthly finance routine, where not only are we looking at what's already happened, reviewing the P&L, reviewing the balance sheet, but also looking at this forecast every single month and updating it so we have at any point in time a really clear snapshot of what the next 6, 12, 18 months is going to look like in our business. Change it. So why do we need to do a forecast? Why can't we just, sort of coast through and, just kind of go with the flow? Well, you're not going to achieve your goals that way. Like, bottom line, if you have a big goal in your business, you're not going to achieve it by just sort of letting things happen. And so forecasting gives you a plan, but still being flexible enough to allow you to pivot in, say, a global pandemic as needed to be able to still achieve those goals, maybe in a different way. So what we like to do with all of our clients is really create an annual profit plan. And again, it's a budget. It's mapped out monthly. We've got all of our revenue, all of our expenses looking into the future. So we created the beginning of the year, and then every single month we're looking at it together, updating it again. And this is really allowing us to make smart decisions now that are going to impact the future, allowing us to be more proactive versus being reactive. So this is what something like this could look like. So we have a template called the Profit Playbook, where you can see on the top here, we've got our revenue. We have any cost of goods, all of our expenses. This is just a little screenshot. And you can see it's laid out exactly like your P&L. The difference here is that you can see we have a column for every single month. We've got it laid out. And what we do every single month, we start at the beginning of the year, and the whole thing is our projections, our forecast, our best guesstimate as to what's going to happen this year. Each month, as we finish our bookkeeping and close out the month, we go in and we update the actuals for that month. And then we look at the forecast for the rest of the months and see, if we need to change anything, whatever. And so then the next month we go in and update the actuals for that month, and so on. So what you have there is really a combination of what's already happened plus what you think is going to happen equals like a very clear picture, again, of what the next 12 to 18 months could look like. So right now, for example, we are in all of our clients' profit playbooks, and we are updating November with November actuals, and we are forecasting not only the month of December, but also all of 2021. So they can really see literally 13 months into the future of their business. And that's not to say that things aren't going to change. They absolutely will change, but they have a roadmap, they have a plan, so that they know, okay, well, now my Q1 goal is this. I can see, the numbers here all in one place. And it's really, really helpful to help them achieve their goals. So the other thing that we do in this profit playbook is the same exact sort of forecasting process, but with cash. Because we know that revenue, expenses, and cash are all different, right? And I know so many businesses that, when I ask the question, like, how are you managing cash flow? Most people usually raise their hand and say, like, I purchase and I do things based on how much money is in the bank at the time. That is not a very proactive way of managing your cash flow, because what will happen is that maybe a client or a customer paid you in advance for something, and then you're like, ooh, I have a lot of money in the bank, like let me go out and buy this, you know, new piece of equipment or this new computer, or like let me hire that person I've been wanting to hire. And then 3 months down the road, you're like, ooh, not a lot of cash has come in because this person paid me in advance, and now I'm like in a crunch, you know, position in terms of cash. So this cash flow is really similar to that forecast I showed you on the last slide, where we're plugging in actuals as well as our forecast. It's actually linked to the other sheet. So anytime we change the forecast and say, oh, this, you know, $10,000 in revenue is not coming in September, it's going to come in December instead, this cash flow updates. So you can see, what's that going to do to my bank balance then? Okay, well, maybe that's going to put me, you know, into too low of a balance, and I need to move around some expenses. Again, you're doing that like months before this actually happens. So you're never in the position where you're like, oh my goodness, I don't know how I'm going to make payroll next week. So I think that this piece of forecasting your future is just, it's so critical for business owners, not only to like grow and scale and achieve your goals, but also to just like manage the day-to-day of your business and not be, you know, terrified of your cash flow, basically. So the last piece, and Amy, you can advise if we've got time. If not, we can kind of skip this. But this is basically like, now what do we do with this information that we have, right? We've dug a little bit into our numbers. We understand the story that they're telling us. We've created this plan for the future. Now, what is a smart decision? Like, what does that actually look like? So on the revenue side, if we're like, yeah, I can't cut expenses anymore, but why is revenue not as high as I want it to be? Well, you can look at your P&L over time and say, what has been my most profitable activity? Where have I made the most money? Because sometimes it's not what you necessarily think, but the data never lies, right? So double down on what has been most profitable. Keep your current clients and customers. If that, you know, if your current model is working, like let's focus on nurturing and engaging what we already have. On the expense side of things, I think that, again, doing this exercise where we are looking at our financials monthly as well as then forecasting into the future, you can see, I am sure that all of us have some unnecessary and unused subscription expenses hanging out behind the scenes that we have forgotten about. I think we have all subscribed to the thing that we thought was going to be awesome, and then 3 months later we haven't used it. We're still being charged $19.99 a month. There's probably that hanging out there. So get rid of those. You know, especially during COVID, a lot of people were postponing non-essential activities. And again, using that forecast will help you determine the timing of something. Maybe you realize, oh, my bank balance is low in March. I think I've got to wait and do this in June. So you can do that, again, very proactively. Again, decreasing expenses, maybe it's not necessarily decreasing, but reallocating funds to expenses that are going to drive revenue, right? So we have a lot of clients that run Facebook ads to sell their digital products. And so they are getting like a 3-to-1 return on that. So instead of spending money on this other person, you know, doing whatever, they're going to double down on those Facebook ads that are giving them a 3-to-1 return. And then one thing that we also recommended during COVID, especially in the beginning, was building relationships with your vendors and your service providers, so that if you did ever need to take a little bit longer to pay them, or, you know, maybe they give you a discount or something, having those relationships in place is very helpful. And let's see, cash flow. One thing I see all the time too is people have a huge accounts receivable and kind of forget to like ask their clients and customers for cash. And so making sure that that you're staying up to date on your AR and you're reaching out to your clients and customers regularly to bring that money in the door is really important, not to let that lag. And on the flip side, money going out, if there's ways to, maybe you normally pay annually for something, and if you're feeling a little bit tight in terms of cash flow, spread the payments out to monthly instead. So I think a lot of times we think there's no flexibility with some of these things, but there really is, and literally all you have to do is ask. So we talked about making sure that your foundation of your business is strong and legit. We talked about reviewing your financials and looking backwards, and then forecasting your future and looking forwards in your business. We don't have to do this one. It's just kind of exactly what I just said. And then, yeah, I mean, with a little financial knowledge in your back pocket, you really can be the CFO of your company. It really doesn't take a lot, as long as you can change the next slide. As long as you're making your financial check-in a consistent habit, right? We cannot just do this once or twice throughout the year whenever we remember and expect to have this like wealth of knowledge and power at our fingertips to be able to manage our businesses. It's got to be consistent. And then the last one, I really believe that knowing your financials, knowing your numbers in your business really, really closely is the key to growth, success, and most importantly, in my opinion, impact.
Yeah, Stephanie, thank you. This was wonderful. And I think for a lot of people, again, we had quite a few people reach out to us to say, I can't attend, but I'm really interested in listening to what it is that you guys are talking about. I appreciated how you, told the story of the different parties that need to be on your financial team. And one of the things that I think is most helpful is when you walk through that projection stage where you're actually looking at what am I projecting my revenue to me? If you're not meeting those goals, then that's where you can sit down with yourself and say, what's getting in the way? What's the barrier, right? What's stopping me from achieving the goal I said I wanted to, or the goal that we anticipated that I would raise? In a normal year, I'm not saying in a pandemic, a lot of people didn't reach their goals this year, but having that coach, that CFO coach though, at the same time, I know from my own personal experience that when I'm just running the numbers, I'm not asking myself those questions. I mean, I am, but I'm not, I don't have somebody looking at it from an outside perspective saying, well, why? And then me giving the answer and them saying, that doesn't answer the question, why? In a very, supportive way.
Yes.
And that's really one of the benefits of hiring that team, right? Is because they're all going to ask in their own different way, why are you doing this? Like an attorney might say, well, you should have, an LLC or an S Corp. Or if you say, I want an LLC and an S Corp, they're going to say, why? What's your purpose for that? Where we're more involved with combining the numbers together from a standpoint of those personal and professional savings for retirement and protection of your personal and your business assets. You're really looking at it from a standpoint of, let me guide you down the path of your financial statements. Let's plan with your financial statements to make a difference and to achieve those goals. And I just wanted to recap that because I think a lot of people have come to us and said, can you serve in that role? And we're like, we can serve in the role of the, wealth building and in the protection side and in planning, but we're not that CFO. And that's one of the reasons why we've collaborated with you, even if I can't pronounce your name properly, your services, to make sure that there is a resource that we can give people to grow forward with that. And I just wanted to reiterate that and say thank you so much for taking the time today to share your process and how you work with people and some things that they should be looking at if they're not quite there yet, just to get themselves prepared so that when they are at that point, it's not starting from scratch and trying to scramble. Because what's the biggest mistake that a solo or a small business does? They wait until the pain is so bad and then they hire somebody. And then it's even more painful because they don't have the time.
Yes. Yeah, exactly. And then you've also just lost so much time where you could have that insight into the future and have nice, clean and tidy numbers to be able to help you do that. And you've lost all that time as well. So yeah, I think, the most important, I like that. What's that saying? Like the best time to plant a tree was 30 years ago and the second best time is now, or something, I'm like probably butchering that, something along those lines. So the best time to get a bookkeeper, get a CFO on your team, is, when you start your business. And if that already happened, that's okay, because the second best time is now.
Yeah. Well, thank you so much again. We're very excited about the collaboration that we're going to have with you, and we'll have more details rolling out here relatively soon in the weeks coming about that specifically. But we wanted to make sure that everybody understood that they've still got some time before the end of this year to wrap some things up. And if you do have any questions, don't hesitate to reach out to us. So thank you very much, everyone, for your time today. I'm going to stop recording. Hold on one moment.